Guys, so the trade war with China is in full swing. At this point, here's where we stand. The United States has imposed 145% flat tariff on all Chinese imports. China went ahead and retaliated by imposing 125% flat rate on all of the United States exports into China. And they added that they have no intention of escalating further, since at 125% tariff rate, none of the US goods coming into China will be competitive in their market. They also have other tools in their toolbox that they could deploy, not just a flat tariff rate on our goods. And they went ahead and used some of them already. Number one, they banned US films from China. And that seems like a minor thing, who cares? Our cultural exports are not that important, but Hollywood does get a big chunk of their profits from the showings in China. However, things did get even more heated on Sunday when China went ahead and imposed a ban on all of their rare earth mineral exports to the United States. Now that is a real big hit to the United States industry, because they need those rare earth minerals, and specifically refining of those rare earth minerals, because we can probably mine them, but the refining facilities are all in China, which is a huge hit to the United States. But that is not all. On Friday, it was reported that some of the goods coming out of China, like electronics, cell phones, laptops, those will be exempt from the tariff rates that were announced. And a lot of people were really happy to hear that news. They said, well, see, cooler heads are prevailing, and there are obvious winners from these exemptions. Companies like Apple, and other companies that are producing electronics here and are sourcing a lot of their stuff from China. But on Sunday, Trump went ahead and started clarifying that, no, you guys misunderstood what we're saying. He had a post on Truth Social. Lutnick, who is Trump's Secretary of Commerce, went live on the news and basically explained that you guys misunderstood all of this.
Pharmaceuticals and semiconductors and autos, he called them sector tariffs. And those are not available for negotiation. They're going to be outside the reciprocal tariffs. And he was just making sure everyone understood that all of these products are outside the reciprocal tariffs, and they are going to have their own separate way of being considered.
There are two separate buckets, and there's a bucket of goods that are critical to U.S. national security, and those will be negotiated separately. Those will have a different tariff rate that is yet to be announced. To make things worse, as all of this is unfolding, we're seeing wild swings in the 10-year treasuries. We are seeing dollar collapsing in value relative to other developed currencies, and we're seeing gold hitting all-time highs. This weekend, spot price for gold hit $3,230, and it went even higher than that, but it kind of settled around that price at the time of the recording. Now, gold is up 22% year to date. Gold is a safe asset. This is not Nvidia stock, so moves like that are unprecedented. And they should be worrying. They should be telling you that there are a lot of central banks, there are a lot of investors around the world that are super concerned about what's going on. And there's this flight to safety happening. Now, as the price of gold is going up, you would expect other traditional safe haven assets to also go up. But there are caveats. So first, let's talk about the 10-year Treasury note. Imagine you're letting United States government borrow some of your money. In return, they're paying you interest on that money, also known as the yield. It's basically a super safe IOU from Uncle Sam. The reason it's important is because that 10-year yield is tied to a lot of things like the mortgage rates, car loan rates, credit card interest rates, and overall it's a pretty good gauge for the health of the US economy. Let's take a look at what was happening to the 10-year yield during this whole chaotic sell-off. So after Liberation Day, when Trump first announced his tariffs, S&P 500 sold off aggressively, and we saw predictable behavior in the treasuries, because as S&P 500 was selling off, right, the outflow of the money from the stocks had to go somewhere, and it had to go into safe assets like U.S. Treasuries. And because there was an increased demand for U.S. Treasuries, they were able to lower the yield on U.S. Treasuries, and that's exactly what we saw. However, on Tuesday of last week, there was a very unexpected spike in the 10-year treasuries. And that spooked a lot of people. And the president actually cited that was one of the reasons why he decided to do the 90-day pause on the tariffs.
Reverse course. I was watching the bond market. The bond market is very tricky. I was watching it, but yeah, I saw last night where people were getting a little queasy.
It wasn't necessarily the magnitude or the percentage itself that was concerning, because we hovered around 4.5% range for a while now, if you look at the graph, over a longer span of time. But the rate at which it shot up was concerning, because what that spike meant was that somebody was dumping U.S. Treasuries. Was it a hedge fund that was getting margin called because of the positions that they had, and now was getting liquidated, it needed liquidity, and had to sell off their Treasury holdings? Could be one of the explanations, right? Another explanation is a little bit more conspiratorial, but also holds some weight. You could imagine that a lot of the foreign U.S. debt holders, which China is our largest foreign debt holder, they were potentially dumping U.S. Treasuries as well. And if they decided to actually pull that lever, that would be cataclysmic for the United States economy. Now, relatively speaking, China is holding a small portion of our overall national debt, but it would be enough to create a lot of chaos. It could be one of the strategies they could resort to as a strategy of last resort in this trade war. Now, the United States economy is super intertwined with the Chinese economy. I mean, America is their market and they're a big factory, right? So the factory cannot exist without a customer. However, it's a lot easier to find customers, right? You can start selling to your domestic market. You can find other trading partners. Yes, it will be painful to readjust, but it's possible. It's a lot more difficult to switch over from being a consumer to being a producer. And that is the concerning part here. Again, we're seeing gold breaking out, right? Hitting all-time highs. And at the same time, we're seeing 10-year treasuries also going up. Historically, as gold prices are going up, U.S. treasuries, or the yield on the 10-year treasury, is going down, right? So the only time that rule doesn't hold is in a time of crisis. Like we saw the same behavior during the 2008 crash, right? So, it remains to be seen. Was last week an anomaly? Was that just a blip in time? Or is this a trend? And so I would suggest that you guys pay attention to the 10-year yield and the gold price and see how they correlate. Because if we continue seeing this establish itself as a trend where gold is going up, yields are going up on the 10-year treasury, not a good sign. That would be the time to panic. That would be the time to restructure your portfolio and be risk off. Definitely don't go on margin and buy the dip. So, I've listened to a podcast, a couple of guys in the iced coffee hour talking about this is the best opportunity of our lifetime. Load up, put all of your savings in the market, throw them in the market. There's nothing but the upside. I would be cautious about doing that, because what I'm seeing happening this time around is a restructuring of the world order. And Ray Dalio has a good video. He has a good book on this. It's called The Changing World Order. I suggest you guys look it up. He also went on the news today and talked about how he sees things.
And I'm worried about something worse than a recession. We have something that's much more profound. We have a breaking down of the monetary order. We are going to change the monetary order. So if you take tariffs, if you take debt, if you take the rising power challenging the existing power, if you take those factors and look at the factors, those changes in the orders, the systems, are very,
He's basically
very
calling it like it is. The monetary order of the world is quickly changing. A lot of people are really into the graphs. They're so zoomed in and they're looking for patterns and recognizing correlations and measuring things. But the macro perspective is also super helpful because, think of it in terms of history. If you look at the United States history, we're a very brand new country, right? 200 something years old. And the market, S&P 500 and U.S. stock market is also very new. So we're living through a historic shift between the powers and restructuring of the world's trade. Yes, Trump can go ahead and cancel the tariff tomorrow, but the damage is done. We've passed the point of no return. Maybe we can bounce back to some sense of normalcy, but the processes that were activated will continue to go on. The relationships with other countries are damaged, right? And it's easy to stain your reputation. It's a lot more difficult to build a reputation. You know, United States had this, at least it communicated this posture of benevolent ruler, right? The good superpower, you know, and Soviet Union and China are like the empires of evil. But that veil of benevolence has kind of been torn off when we hear statements about, well, let's just annex Canada and they're our 51st state, or, well, we'll just take Greenland. This is going to be our new territory. Things like that, behavior like that, where we go to war basically with the whole world, is a little bit too arrogant. And what this trade war with China has revealed is that maybe we don't have all the cards. China calmly escalating the trade war has blown a lot of people's bubbles about the position that our economy is in. Yes, we're super powerful. Yes, no single country can stand in our way when we're dealing with them one-on-one. But when we're calling out the whole world, you know, things are a lot different. And so I understand that the status quo with the US economy is unsustainable, right? We can't just continue this deficit spending. And I do think that Department of Government Efficiency is doing a lot of good. But one of the unintended consequences of airing out our dirty laundry, so to speak, of how a lot of these funds are being mismanaged, what that shows to other countries is like, hey, the money that is being mismanaged is the money that we gave them. Like, we're spending this money on a credit card. Guess where this money is coming from? Well, a lot of it comes from our foreign US debt holders. And when they're spectating and they're getting disillusioned about how things really work around here, right? That has a lot of unintended consequences, including a huge reputational damage. And the market volatility that we're experiencing now, you know, a lot of traders are excited about it because, you know, they can buy the dip, they can time the market, they can make good returns, but long term, the correlations can stop correlating, right? People that are deep in the charts, just looking at it, just another buy the dip opportunity again. I might be proven wrong, but something is telling me, just my gut feeling on this is way different. This is a big historic pivotal shift from the world order that we lived under since Bretton Woods Agreement. I think Liberation Day basically will go down in the history books as the day that ended that Bretton Woods Agreement era, and now we're entering the new unknown phase. And you know, we might be able to pull through. Somehow we always did. Maybe AI advancement and reshoring, reindustrializing with automation can be the solution. Maybe we'll become this high-tech, highly industrialized society where everything is automated and AI is being leveraged to its maximum capacity, but that's a long shot. What we have right now, the reality on the ground right now, is way different. Will we see the greatest crash of them all, the biggest bubble pop, or will we enter the new golden age? Curious to know what you guys think about this. Are you buying the dip? Are you staying on the sidelines? Are you out of the money to buy the dip? Let me know in the comments below, and I'll see you in the next one. Bye.